Good afternoon and welcome to the MENHADEN Resource Efficiency PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to CEO Ben Goldsmith. Good afternoon.
Thanks, Alessandro. Hi, everyone. Thank you so much for taking the time to come and hear about MENHADEN. We've got a little slide deck which we'll talk you through in the assumption that most of you don't know us. So we will go through all the slides, but we'll do it quite breezily and make sure there's time at the end for questions and so on. So we are a London-listed investment trust with a market capitalization, annoyingly, of 76 million, given that our net asset value is 121 million. And as we'll discuss in a bit, that 121 million is comprised of quality blue chip equities and a handful of high quality private equity and private debt co-investments, which we've made alongside some blue chip firms. So on the back of the quality of the portfolio, this really ought to be trading much closer to NAV. And I suspect that will be at the heart of our discussion today. The objective is really to be a bit like a family office in a sense. Between Luciano and I and our respective families, we own between quarter and 30% of the shares in issue. So our interests are completely aligned with those of our shareholders, and we have a long-term mandate to protect capital whilst compounding at a rate that is higher than inflation. In fact, we have a benchmark which is inflation plus. So this is the team. It's me and Luciano day to day running this with Teddy Bybus, who's our investment analyst. Luciano is the CIO. I tend to run the business and focus more on the identification of private equity and private credit deals. Previously, I set up WHEB Asset Management, which you might want to look up. It's a long-only sustainability themed listed equities business with about 1.5 billion pounds under management, and most of whose clients are in the UK. So I've been involved in the world of sustainability investing since I started work. Luciano is a former credit investor with Barclays and with a long career in banking, and is fundamentally the lead portfolio manager. And investment decisions are taken with unanimity by an investment committee that also comprises Graham Thomas, who's chairman. Graham is not full-time with us and was previously effectively chairman of the executive committee at RIT, which is another word for chief executive at RIT, reporting to Jacob Rothschild. He was there for 5 years. Graham runs a private equity business called Stage Capital at the moment, which is backed by Goldman's and Deutsche Bank. So that's a team. We're a small team, and we've worked together now since 2016. The board is independent, so it's a public company, MENHADEN Resource Efficiency PLC, with this board, and they subcontract portfolio management to our LLP, to Graham, Luciano, Teddy, and I. Howard is the chairman, used to run the Environment Agency pension fund for a long time. Both Soraya and Barbara come from the world of investment management, and Ian is a former FTSE 100 chief executive. Ian's had a number of major non-exec positions since running Kingfisher, but the reason why he's on our board principally is because he was one of the first FTSE 100 chief executives to invest heavily in the efficient use of resources while he ran Kingfisher, which is the parent of B&Q and Castorama and so on. So it was really Ian Cheshire and Stuart Rose of Marks and Spencer who pioneered this idea that we can be much more efficient in our use of resources and that the payback is very rapid. Marks and Spencer's Plan A, it was called, with the strapline, because there is no plan B, was pilloried at the time, some of you may remember, but ended up producing a massive return on investment through more fuel efficient vehicles and LED lighting in the stores and more efficient refrigeration and reduced waste and so on. So Ian and Stuart Rose were kind of the first in the FTSE 100 to do this, and so he understands our investment theme. So we're long only. We're not a hedge fund. We're not shorting stuff. We're not trading, but we do have a multi-asset strategy that allows us to invest across publicly traded and privately held investments, equity and credit. We can invest globally, but instinctively we lean towards the US and certainly to developed markets. We don't like binary outcome positions. We don't do distressed credit. We don't do venture or growth capital. We don't do emerging markets or frontier markets. And we have a concentrated portfolio. It was always the goal to have a portfolio comprised of a handful of positions that we really know well and we really care about. So kind of 15-ish is the number of positions. And the highest conviction ideas can be as high as 10% or more of NAV. Currently, our largest position is 12% of NAV. And we don't trade, as I said, it's low turnover. We're really happy with the quality of the portfolio. We try to do as little as possible. In terms of the theme that interests us, the way I presented it to Graham when we first met in 2014 was, let's create a green REIT. And what we settled upon after a period of discussion was a focus on companies which either deliver or materially benefit from the efficient use of resources. So if there is a green industrial revolution taking place, I think we can all agree there is, at the heart of the story is one of resource efficiency or circularity of resource use, replacing linear resource use. And across all industrial sectors now, businesses are stepping up to this challenge and generating investment returns from doing that. So this disruption that's taking place gets faster and faster, and there are regulatory drivers, there are fiscal drivers, there are commodity price volatility drivers, there's consumer pressure and so on. And we like to invest in companies which are leading the field within their respective sectors in this space of resource efficiency. Alongside this, we like to invest in companies which have strong competitive positioning. And we find that competitive moats in all sectors are under siege by disruption. We've never seen such disruption in the world as takes place across industrial sectors today. So we like companies which have particularly strong competitive positioning in the form of high entry barriers, and therefore which have pricing power, which is important in the current inflationary environment in particular. So we have a little Venn diagram here which describes our investment process, but resource efficiency is the theme that interests us, and that's quite wide. That's companies which either deliver or materially benefit from the efficient use of resources. We have Microsoft, we have Airbus, and we'll explain the logic behind some of those shortly. But this is a broad definition of green. We have a second part of the Venn diagram, which is quality. So the idea is to invest in companies which have strong balance sheets, which have cash flows that are predictable, cash flows that we can predict with some degree of comfort. Companies which have high entry barriers and therefore strong competitive positioning, pricing power. Companies that are not going anywhere. We invest along the sort of Buffett school lines. We like quality, and then value. A more accurate term might be valuation. We're mindful of the entry price at which we invest in everything that we look at, certainly we're mindful about valuation. If we buy growth, we like to buy growth at value, and it's in the center of that Venn diagram that we like to allocate capital. And once you get into the center of that Venn diagram, there aren't that many opportunities out there. So it suits us to have a concentrated portfolio, limited number of positions that we really believe in, that we know very well, and that we hold for the long term. And the same applies to our approach to private investments. So to the extent that we're investing in anything which is not publicly traded, we'll only do so if it fits that Venn diagram. In other words, high quality, resource efficiency, and where the lead investor is not investing at a crazy valuation. And there's a fourth criterion, and that is that we're able to co-invest as a minority behind a leading investor, a KKR with whom we've co-invested 3 times, or an Apollo, or TPG, or TCI. And I spend a lot of time cultivating relationships with these firms, and our private equity track record is excellent. On all the deals we've done since the IPO, we've made money. We've made excellent returns in line with the returns we've made in our public equity portfolio. And we've done that by investing in high quality deals alongside the best investors in the field on preferential terms. So we'll talk about terms in a moment, but we've tended not to pay management fees. We've tended to be in as friends and family behind some of these firms. So this is a little snapshot of the portfolio. and the sectors that interest us. I don't know whether this is the moment to pause on some of the portfolio companies, Luciano, or we'll do that when we reach the top 10. I think we'll keep going. So this is how we go about stuff. So the idea generation on the private side is typically me, and the public equity side is Teddy and Luciano. They pass our screen, pass a process of fundamental analysis. We're in no hurry. We're not traders. We write a full IM, and then decisions are taken with unanimity by the investment committee. And it's quite a thing when we add a new position, and it's quite a thing when we trim or remove a position. We're not traders. We're much more of a family office in that sense. So it's conceivable that the portfolio would be as much as 50% invested in private positions. In practice, that's unlikely, but certainly at the moment, 15% in private investments reflects the fact that we've struggled to find deals that fit our criteria. We found that a lot of the private equity funds that we work with have raised some very large funds, and they're paying inflated prices with lots of leverage to try and force returns. And therefore, we've struggled to find deals during the last couple of years. Suddenly, in the last 6 months, we've come across ideas that appeal to us, and we're optimistic that we'll have more private deals in the portfolio in the next 6 months. At the moment, we have a 15% weighting to private equity, and that's mostly one deal, a company called Excelio, which is a solar asset developer operator, where the lead investor is KKR, and the company is being sold to Brookfield. It's all in the public domain, and we're expecting cash proceeds representing almost 3 times our money after 5 years, IRR during that period of mid-teens, towards the end of the year. When that deal is completed, we'll be down allocation to price off the whole time. For those interested in our approach to ESG and our approach to stewardship, we're not an ESG fund. We are mindful of environmental, social, and governance considerations in every decision we take. Mostly because we think in today's world, companies which are not smart and focused on environmental considerations, social and governance ones, are not well managed companies. We think it's a material financial risk in today's world not to be well managed from an ESG perspective. So we are an ESG fund only to the extent that all good investors today are ESG funds. We don't market ourselves as an ESG or an impact fund. And we take our responsibility as shareholders seriously. So we are active in our stewardship of the positions we hold. So we invest in companies which are typically at the leading edge, but many of which could go much further in their pathway to Paris alignment, to net zero, in their impact on the natural environment. And so we engage with those companies in the form of letters on a reasonably regular basis, and we vote our shares in line with our conviction that these things matter. So we're responsible and proactive stewards of the positions we hold without naming ourselves an ESG or an impact fund. And of course, we report our environmental impact. It's more qualitative than quantitative. I've never been so convinced by the idea that a pound invested in our fund is got a less quantifiable carbon intensity that's different from a pound invested in another fund. I don't know how much impact that really creates in the real world. So we tend to focus on narrative and our efforts as shareholders in pushing the companies in our portfolio to do better. And we've got a bunch of things happening along those lines. We have one question which I'll just pause on. Given the lack of transparency with some of your investing companies with regards to their environmental performance, what steps have you taken to improve this? So we work with an advisory firm called ESG Communications, a guy called Elliot Frankel, and we review each position in our portfolio on a regular basis. And where we think our portfolio companies are falling short, we correspond with them, and we make our views clear, and we generally hear back from them. And so there is a dialogue. We're also signatories to a number of important initiatives, for example, CDP's initiative on emissions. We expect our portfolio companies to report their emissions through the CDP platform and we use our position as a very small shareholder to encourage them to do better where there is scope for them to do so. And we vote our shares according to our conviction that all of our portfolio companies should be aligned with the Paris process and doing their best. So we're active and engaged shareholders. I think if any of our portfolio companies were to fall very short, I think we would consider divestment as a final option. So the track record is good. We had a difficult start. Some of you on the call may know that we had a bunch of venture in the portfolio and a little bit of a mishmash at the start before we brought Luciano in as lead portfolio manager in 2016. So our performance since inception is a little shy of 6% net of costs. That's because we were down 22% in the first year. Since 2016, with the rethink of how we go about things, we've been one of the best performing investment trusts in the London market at the NAV level. So we've compounded at 9% over 7 years, at 10% over 5 years, at 8% over 3 years, and this year, the last year full year period 9%, but year to date we're up more than 20%. So we're one of the best performing investment trusts of any kind. We're in the top 2 or 3. And so what we're doing is working. You know, the strategy that we are pursuing and on which we're disciplined, it works. Like, we have our own money in this. We're very pleased to have our money in this because we're producing performance, and we get on well as a team, and we're good at creating ideas, and we're good at following through with those ideas. We have access to private deals which are off market, and we're able to invest in those on preferential privileged terms. We've created something good. We'll talk in a moment about the share price, but we, suffice to say, don't feel that the market is giving us credit for the performance that we've produced. And the performance is well spread across our private and our public positions. What were the merits of the recent investment in Airbus? Okay, so given Airbus is our biggest position, if I may at this stage pass over to Luciano to explain the rationale behind why we bought Airbus back, having held Airbus, having made a lot of money in Airbus in between 2016 and 2020. Why did we buy it back? Why 13%? And why does it fit?
So in terms of resource efficiency, I think it's pretty clear that both Airbus and Safran, they are producing aircraft and engines that are way more efficient than the previous versions of their models. The new A320neo is 20% more efficient than previous airplanes, so less CO2 emission, less use of fuels. We revisited Airbus on the basis that we saw that basically consumers were basically traveling again back to previous levels. At the same time, Airbus is a duopoly. There's Airbus and Boeing. There's no third option. The Brazilians with Embraer, they don't have the financial muscle to develop similar airplanes to Airbus and Boeing. And this Airbus, there's a 10-year backlog. They have a 10-year backlog. And the current fleet of airplanes used by airlines, approximately 80% of them are the old models. So they need to renew them. And so Airbus is very well positioned to benefit from that. We see very decent returns, approximately north of 15% from where we are. And with a high degree of certainty because of the 10-year backlog, they are going to increase deliveries by 2026. We see them delivering approximately 75 planes per month. So there's a very high degree of certainty getting to the to much higher revenues, earnings, etc. It's very. If you look at this page, we'll see this. What I'm saying in terms of that we have effectively 3 buckets of themes. The aerospace one with Airbus and Safran. Safran makes the engines. Airbus makes the planes. Both similarly, they have their oligopolies or in their respective business. Very difficult to come up with new products. certify a new plane nowadays. It takes like years. It's a huge capex. The same with engines. Then we have a second bucket of technology where we have Alphabet, Microsoft, and Amazon. There's also like very high degree of predictability with cash flows. Just to give you some context in terms of the cloud business, we see high visibility of revenue growth. The market is probably going to be 1.6 trillion by 2032. If just in the case of Alphabet, if they keep their 10% market share by 2032, that will imply another probably more than $30 billion of net income. So again, very high predictability, and there's very little competition between them, right? Alphabet is the monopoly in search, Microsoft in productivity software, Amazon also on e-commerce. And then we have the third bucket, which is basically infrastructure, right? Virtually undisruptible. We have Canadian Pacific, Canadian National, Union Pacific. John Lang, to a certain extent, is also infrastructure. And we have Vinci, that has motorways, renewables business as well, and airports. And we have ports in Brazil. So it's a very defensive portfolio where we see very little downside and high predictability of cash flows going forward. So I think that when you compare us to other listed closed-ended investment trusts, I think the discount seems completely exaggerated on the basis that the quality of our portfolio. Not only the listed portfolio, which, you know, as I said, they're all like monopolies, oligopolies, etc. But even the private deals, where some people see that the high discounts should be taken into consideration with the closed-end investment trusts listed in the UK because of questionable marks with their private portfolio. In our case, our private portfolio is externally marked by, and we co-invest with the best in the industry, as Ben mentioned. So I think that's what I should say about the portfolio. Ben?
Yeah, I just suggest that we touch upon currency hedging. We did used to have currency hedging to the extent of 50% of our euro and dollar exposure. Lucien, do you want to talk a little bit about the rationale for our currency hedging?
So we started hedging approximately in early 2018, and it was on the back of what had happened to the pound, the decreasing value of the pound after Brexit, etc. So we wanted to protect the gains we made in FX at that point in time. I think the hedges have been successful in that sense. Obviously, the pound has depreciated, therefore the hedge effectively has moved against us. It has cost. There was a cost for doing that, and currently, because of the market conditions now, banks are currently demanding more collateral, and at the same time, we just see that the pound. There's very few reasons to be bullish the pound going forward, at least in the medium term, with the elections, with the fiscal situation in the UK. So I think, and given the fact that, you know, banks are being a lot more draconian with demanding the collateral with the eased agreements, we probably at some point we might revisit that and stop hedging. Other successful funds like Fundsmith, they don't do any FX hedging, and many of the listed closed-end investment trusts, they don't either. So we think that in the current context, we might change our policy.
Lucien, just revisiting Airbus briefly, could we please provide a bit more color on our investment proposition? I'm struggling to match up the resource efficiency case for holdings such as Airbus.
Well, I mean, what we said, what the prospectus says is that we invest in companies that either benefit from or deliver the efficient use of resources, we could invest in an oil company that is more efficient than another oil company. In terms of resource efficiency, I mentioned before, as I said, that the new planes are 20 to 25, in some cases up to 25% more efficient. They use 25% less fuel, 20% less fuel than the previous models. So there's huge incentives for the airlines to buy the new ones because they are saving money, and at the same time, these new planes emit between 20 to 25% less CO2. So that's the resource efficiency case for Airbus and Safran.
And in terms of Alphabet, our second biggest position, Alphabet is the world's largest buyer of renewable energy. So Alphabet's 100% powered by renewables, many of which the company owns itself and some of which it buys from third parties. But among the tech businesses, Alphabet's the largest user of power, and the whole lot comes from renewables. It's also using its DeepMind artificial intelligence technology to create data centers that are way more efficient than anyone else. You know, undoubtedly in the tech industry when it comes to renewables and circularity and so on. But you know, lots of improvement to make. But you don't buy Menhaden, I don't believe, to make a difference in the world. You buy Menhaden to have your money invested in a sensible way, which is responsible in the mainstream. Should we talk about the private investments? I'll just talk about the rationale behind TCI. So TCI is a hedge fund in London. So Christopher Hone is the manager. It's one of the best performing hedge funds in hedge fund history. Since 2003, they've produced something like 16% annually compounding returns. So Christopher Hone is also, as it happens, one of the world's leading climate philanthropists who hands out about $500 million a year on climate and other social causes. He set up a credit strategy about 8 years ago called TCI Credit Fund, which puts out large loans to developers in the primest of prime locations, Los Angeles, New York, London, Tokyo, and they're blue chip developers, Four Seasons and so on. And the way they're able to generate returns in the region of 11 to 14%, which is where the previous funds have come out, is because it would take a developer a long time, months and months, to syndicate these massive $500, $800 million loans among a bunch of banks. TCI can move at that size very, very quickly. So they've got a wonderful track record. They lend with a charge over assets at sort of 60% at most loan to value. They charge double-digit interest rates. They've got a great track record, and we've been able to invest in that fund on a friends and family basis. Previously, we're now in their most recent fund. The commitment is 25 million US, although we don't envisage that the fund would ever be on a net basis more than 70% at maximum draw. So because the drawdown notices come concomitant with repayments back. And so at the peak, you might be somewhere between 60 and 70% drawn. So it won't be as big a position as the commitment might indicate. And we think this kind of short duration credit is a good place to be given our mandate. And the buildings that are financed by this are buildings which are at the leading edge in terms of environmental sustainability. That's one of the things that they market themselves on, TCI and the credit fund, is that they back the greenest of green buildings that are out there. So we think it's a good one to be in, and it fits nicely within our private portfolio as a kind of reliable private source of yield, preferential terms, co-investing alongside one of the best names in the business. In terms of fees, Luciano, do you want to summarize the fees on the TCI fund?
Yeah, the previous one, the TCI Real Estate 3, had no management fees and a success fee of 20% above 8%. The new TCI Real Estate 4 has a 50 bips, so 0.5% management fee and success fee of 20% above 6%. The returns expected on the TCI Real Estate Fund 4 are in the order of 12 to 14%. So we expect very, very good returns on the current one. There was a question about if you could clarify whether we are currently hedged or not in terms of currencies. We are. What we said is that we're going to revisit whether we will continue the hedges or not.
So this is our private realizations. We've made money in every one that we've done. The IRRs have been range from 15% up to as high as 85% with a Perfinco investment in Brazil, but they're all infrastructure-like, real estate infrastructure, kind of real asset deals with cash flows that are predictable, with solid assets, and usually some kind of upside story. And in each case, there's a co-investor. So with ADO, that was with Apollo. With Calicine and Excelio, it was KKR's infrastructure team. And the Perfin Apollo 12, Perfin is one of Brazil's leading infrastructure investors. So we'll continue to do those kind of co-investments as and when we find them. So this is NAV performance since inception. And you can see the low point was conveniently for Luciano about the time that he joined. And we rethought the strategy and since then I've pursued a quality and value approach only. We've rigorously excluded anything that might be binary in outcome, venture, growth, distressed credit, anything like that. And it's worked. We've produced 10% performance over almost 8 years, which makes us pretty much among the best investment trusts in London. It's really working. The problem is this. The discount has narrowed to as little as 20 at times, and currently it's as high as it's ever been. The NAV has been going up and the share price has not been following. So the company has done a little buyback. The board authorized a buyback in July and has bought almost 1 million shares back in since then. That is an open buyback at the moment. It's a board decision to do that. It's not our decision, of course. And we have been buying as well. So between Luciano and I, as I mentioned, and our respective families, we own approximately 27% of the vehicle. So we think this is a screaming buy at this stage. It just doesn't make sense that the discount should be so wide. Something's got to give. Either the share price has to find some elasticity and ping back up closer to the NAV, or something's got to give. It can't persist at this level, especially given the quality of the assets that are underlying and the quality of the performance that we've produced. What we have, it really works, and our ambition is to be doing this for a very long time. We want to be the next Caledonia, the next RIT. You know, we want to be around for a very long time, for decades. We're very happy running this. For as long as it works, which it is, we want to keep doing it. If performance had been poor over 2 or 3 years, I think we'd be having a very different discussion with shareholders right now. But the fact is, it hasn't. It's a quality vehicle with a quality strategy and access like very few others. It's not easy to get these co-invests with TCI, with KKR. These are things which are really special. We think the vehicle, therefore, has a future, but we have to nail this discount. And that's why we're doing this webinar. That's why we're out. We've just been in Guernsey last week speaking to our largest shareholders. I gave the keynote address at the Guernsey Sustainable Investment Week. We're doing a whole load more. You know, we've been very focused on recovering the NAV, and that's worked well. We have not been focused enough on marketing the stock. So we want to create that drip of demand that sees the discount narrow. And of course, as the NAV increases, our total expense ratio decreases. And that's an ongoing benefit of good performance. So our total expense ratio is now lower than some of the comparables I mentioned earlier in the context of comparative performance. You know, that's another positive. You know, I think our goal is to continue compounding at double-digit rates, and the size of the vehicle will just inherently, therefore, increase liquidity. Now, if we keep on compounding at the same rate, we'll be at $250 million in 6 years, you know, in terms of NAV. And when the market cap crosses lines such as 100 million, 150 million, then that increases the breadth of organizations which can buy our shares. At the moment, we're too small for some of the wealth managers, for example. And as we all know, those wealth managers are becoming more and more restrictive at the center in respect of what their teams can buy for clients. So and a lot of those are just simple size thresholds. So we think if we just brave this out, continue performing, we think that in due course, compounding should see the liquidity increase and the discount significantly narrow. That's the goal. And the purpose of this call is to persuade you all to buy more shares, because we think it's a great buy at the current level. I wonder if anyone has any further questions. If they do, perhaps they could shove them in the Q&A. Failing which, we might be done.
Yeah, perfect. Ben, Luciano, I think you've actually addressed all those questions from investors, so thank you very much for doing so. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Menhaden Resource Efficiency PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.